Alright, Shannon S. from Tempe, Arizona asks, what happens to a second mortgage in a loan modification? Well, there's a variety of different things that could happen, and I'll go over each of them just real quick, and then I'll go back and I'll fill you in on the details in just a second. First thing they could do is they could modify the loan separately, and just treat it as a completely separate modification and do the second mortgage separately. The second thing is that your second mortgage could not modify at all. It doesn't happen all that often, but it is a possibility. The third thing they can do is a combined modification where they combine your first and second into a single loan. The fourth thing is a one-time buyout where they reduce the principal balance of your loan in exchange for a one-time buyout. And those happen, those are kind of hit or miss, but sometimes they do happen, and when they do happen, it's generally a pretty decent savings. And the last thing they could do is they could just charge off or write off your mortgage and send you a 1099 for the balance, which means that you'd have to pay taxes on it at the end of the year. In the first instance, when they modify separately, it's essentially the same basic procedure as a first mortgage. You can get a lower interest rate, lower your principal, extend your terms. It's the same basic scenario as when you do your first mortgage. The difference is that it's on your second mortgage. The next possible scenarios that they don't modify at all. Now, like I said, this isn't that common, and the main reason for that is because a second mortgage is in the second lien position, and sometimes even in the third lien position if a person has a tax lien against their home, at which point the second mortgage stands almost no chance of getting the home in a foreclosure situation because they would have to buy the first lien in order to own the property and be able to sell it. And almost no second mortgage company is going to do that unless there's a significant amount of equity within the home. But if there was equity within the home, then chances are good that you could refinance. So the chances of your second mortgage not modifying is not very great unless it's like a private lender or private money, that kind of thing. But it is an option, so I had to throw it in here. The third scenario is that they could do a combined modification. Basically what that is when they take your first mortgage and your second mortgage and they combine them together to make one single loan. It essentially bundles your loans together. And then they lower your interest rate just like they would on a first mortgage and saves you money that way. It's most common on loans that are owned by the same company. So if you have a first and a second with Wells Fargo, you could maybe see a combined modification. If you have a first with Wells Fargo and a second with Chase, the chances of them doing that are almost nil. Once the new terms are assessed, they essentially make it into a single loan. Essentially what happens is your first mortgage absorbs your second mortgage, so you'll see your principal balance rise on your first mortgage, and then they'll modify the terms to adjust for that. And then generally they'll add PMI, which is mortgage insurance, because you won't have an 80% loan-to-value ratio. The next option is that your second mortgage offers you a one-time buyout. And that basically just means the second mortgage could settle for a one-time payment of a reduced amount. And I mean, they're all over the map. Sometimes you can get them as low as 20%. So if you owed $100,000 on your second, they would offer you a one-time buyout of $20,000. Now, the chances of them not 1099 you for that are rare. So just be prepared that if you do buy out your second mortgage, you should expect at the end of the year to receive a 1099 for the remainder of the balance. So in our previous example of $100,000, you pay off your second mortgage with a $100,000 balance for $20,000. There's an $80,000 difference. You're going to get 1099 at the end of the year stating that you've essentially earned $80,000, which means that you'll be liable for the tax on that $80,000. Now, granted, not a lot of people have $100,000 second mortgages, but same applies if you have a $20,000 second mortgage and you buy it for $2,000, you're going to get a 1099 for $18,000. The last and final option for your second mortgage is that they could just charge it off or write it off. And that's not too terribly common. But in some cases, it's more beneficial to the lender to write off or charge off your loan instead of modifying it. They get their tax credits, and they have different ways of monetizing it that way. And basically, it's just when they refuse to work with the homeowner, they write off the complete cost of the mortgage, chances are good you're getting a 1099 for the entire cost of the second mortgage, which means that at the end of the year it looks like you made a whole lot more money. So start saving for the tax implications at the end of the year if that happens to you. So if you like this video and you want to get 20 free other videos teaching you pretty much everything you need to know about home loan modifications, check out easyhomeloanmod.com/20-free-videos. Thanks.